Most people recognize Michael Burry as an important character in the film The Big Short, which tells the story of how Burry predicted the global financial crisis. Burry is essentially the economic equivalent of Batman, rarely seen, but when he does appear, he delivers critical insights before vanishing into the night. He does this mostly through cryptic tweets, which he often deletes shortly after posting. Today, we will discuss some of his latest financial warnings and market insights in detail, exploring what they mean for investors and the broader economy. Before we dive in, don't forget to like and subscribe to our channel. Your support helps us continue bringing you valuable content on market trends and financial insights. Now, let's get started. Burry has been vocal about his thoughts on the financial markets, and his tweets often provide hints about the economy's future direction. Last year, he tweeted that people always ask him what is going on in markets, and his response was simple: the greatest speculative bubble in history by 2 orders of magnitude in everything. Here, Burry was referring to the rampant speculation across all financial sectors, not just in cryptocurrency and high-risk investments, but even in well-established stocks that had become overpriced due to excessive investor optimism. Burry highlighted how even fundamentally strong businesses saw their stock prices inflated beyond reasonable valuations. He warned that these conditions were creating a bubble reminiscent of past financial crises. One of the ways to gauge market speculation is through the Shiller P/E ratio, which compares the average earnings of the S&P 500 companies over the past decade to their current stock prices. Historically, the Shiller P/E ratio has been a reliable indicator of market bubbles. Last year, it reached the second highest level in history, surpassing levels seen during the Roaring '20s just before the Great Depression. Even today, despite significant market corrections, the ratio remains at concerning levels. The standard S&P 500 P/E ratio, which compares recent earnings to stock prices, also suggests that the market remains overvalued. While valuations have improved from their 2021 highs, stocks continue to trade at historically elevated levels. Burry's concern is that this overvaluation could lead to a prolonged period of declining stock prices, similar to what was seen in the early 2000s after the dot-com bubble burst. Burry has also warned extensively about cryptocurrency markets, particularly the dangers of excessive leverage. He once tweeted that if you don't understand how crypto leverage works, you understand nothing about crypto. His prediction turned out to be accurate. Many leveraged cryptocurrency investors suffered massive losses as the market collapsed. Major cryptocurrencies like Bitcoin fell over 70% from their highs, while others, such as Terra Luna, became completely worthless. This rapid decline validated Burry's belief that much of the crypto market was built on speculation rather than intrinsic value. He has also compared Bitcoin's decline to the Nasdaq's performance, highlighting how closely Bitcoin has mirrored tech stocks. This contradicts the popular belief that Bitcoin is a safe haven in times of economic uncertainty. Instead, Burry suggests that Bitcoin behaves like a high-risk speculative asset rather than a stable store of value. On June 13, Burry made another ominous comparison. He likened the stock market to a burning theater where everyone tries to rush out the door at the same time. He stated that it took a decade for investors to become over-leveraged, and it would take more than a year for the effects to fully unwind. This suggests that, in his view, the bear market still has a long way to go before bottoming out. Unlike the brief 2020 market crash, which lasted just 2 weeks, Burry believes this correction could last much longer. He has a history of making bold but accurate predictions. He has identified several financial bubbles and crises over the years, including the 1999 tech bubble, the 2005 housing bubble, and the 2021 meme stock mania. In June 2022, he tweeted a list of past market crises and hinted that we were not yet done with the current downturn, listing the tech bubble, value revival, housing bubble, COVID market crash, lockdown effects, meme stocks, crypto leverage, inflation crisis, and the 2022 market correction as signs of more volatility to come. Burry also took aim at the Federal Reserve, blaming its policy missteps for the current inflation crisis. He pointed out that if inflation were measured using the same methodology as the 1970s, it would already be at record highs. Back then, the Fed had to raise interest rates to nearly 20% to control inflation. In contrast, today's interest rates remain historically low, raising concerns that inflation may persist longer than policymakers anticipate. Burry believes the Federal Reserve has been consistently behind the curve, allowing inflation to spiral out of control while failing to take adequate action. His criticism suggests that the Fed's recent interest rate hikes may not be enough to bring inflation under control, meaning further economic pain could be ahead. Beyond financial markets, Burry has also weighed in on political issues. While we will not delve into those here, it's clear that he believes macroeconomic factors, including inflation, central bank policies, and geopolitical developments, play a significant role in shaping market trends. The key takeaway from Burry's insights is that we are still in a period of economic uncertainty. He believes the current market downturn is far from over, and investors should be cautious. Rather than chasing speculative investments, he advises focusing on fundamentals, identifying companies with strong earnings, reasonable valuations, and sustainable business models. He has emphasized the importance of patience in investing, warning against the risks of overtrading and chasing market trends. Investors who fail to heed these warnings may find themselves caught in a prolonged downturn with few opportunities to recover losses. As we look ahead, the key question is whether the financial markets will continue to experience significant turbulence or stabilize in the near future. Burry's warnings suggest that investors should prepare for prolonged volatility. Some analysts agree with his bearish outlook, while others believe that central banks may successfully navigate inflation challenges and stabilize the economy. Regardless of the specific outcome, one thing is clear. The coming years will require careful investment strategies and a focus on long-term value rather than short-term speculation. Additionally, investors should pay close attention to Federal Reserve decisions, interest rate hikes, and shifts in consumer spending patterns. Inflationary pressures remain a major concern, and corporate earnings reports will be critical in determining whether valuations are justified. As always, it is important to stay informed, adapt to changing conditions, and avoid the pitfalls of speculative trading. Michael Burry's insights, while sometimes controversial, have historically proven to be valuable warnings for investors. Whether or not you agree with his assessments, his track record demonstrates an ability to recognize financial trends before they become mainstream narratives. His warnings about leverage, inflation, and market bubbles should not be taken lightly, and investors should consider his perspective when making their own financial decisions. His ability to anticipate major market events has earned him a reputation as one of the sharpest financial minds of our time. While not every prediction he makes will come true, his overarching themes of caution, skepticism, and discipline are valuable lessons for any investor. The financial markets are unpredictable, and understanding the risks involved is crucial for anyone looking to build long-term wealth. Do you agree with Michael Burry's market predictions? Share your thoughts in the comments section below. If you enjoyed this analysis, be sure to like and subscribe to our channel for more insights on financial markets and investment strategies. Thank you for watching, and we'll see you next time.